Hey guys, Joseph Henson here with Henson CPA Group. This week we're going to jump right in. Why good revenue still feels like financial stress. I'm Joseph Henson CPA with Henson CPA Group. I appreciate you guys joining me. This isn't going to be a super long video, but I wanted to go ahead and get it done for tonight so that you guys could see what we want to talk about. The disconnect most owners feel. Your revenue is up. Your appointments are full. The clinic is busy, but you still feel financial pressure. This is more common than most veterinary owners realize. They feel the pressure. They understand that I'm busy. I don't get a break. I don't understand why, though, there's not money in the bank. Why I feel like I have to choose which bills we pick and pay, which vendors actually get paid within their terms, and which I'm hoping don't just stop paying us. So the revenue is your top line. The profit is what's left after your expenses. So revenue is what you brought in. Single doctor practice, $1.2 million, $800,000. That's your top line revenue. That's before any cost of goods, for any expenses. The profit, you have your cost of goods, you have your operating, your financial, all those costs to get to your net income. Just because you are busy does not automatically mean you are profitable. There are a lot of variables that can go into profitability. Many clinics grow revenue way faster than they can control costs. Spend. That's what you think. That's what many owners think. If I just spend more, I can do it. If I just put more here, I can do that. Not always the case. You have to have growth without just doing it blindly. You need to structure. You need to have less stress. But if you have growth without structure, it will create stress. You can't just throw something at the wall, see what sticks, and hope for the best. You have to be intentional with what you're wanting to do. One of the biggest silent pressures, hiring before revenue stabilizes. Well, if I just bring on another doctor, I'll be fine. Except for you're not. You realize bringing on another doctor, now you work less because you didn't bring in more patients. Over time, stacking quietly. That hour here, hour there, because you needed an errand ran, they needed to stay late for this or that time and a half, it is quietly killing your clinic. Benefits increasing year over year. Do you provide a 401k? Do you provide insurance to your employees? The benefits you're providing are fluctuating. If your employee last year was making $20 an hour, and you have a 401k, you're matching a decent amount if they're putting in what they're supposed to. Typically at that, you'd have a $20 an hour for 2,040 hours. You have $41,000 roughly. If they put in 5% for a typical 401k, you match 4%. So that's an extra $1,632 that they're getting. Now, if you give them a 10% raise, just the $22 an hour, you're at almost $1,800 in added benefits. Health insurance gets more expensive. Everything goes up. The staff that you added to solve workflow problems is actually hindering you. Payroll often grows faster than the margins that you see. You can show profit on paper, but still feel broke. You have loan principal payments that don't show on your P&L. You have equipment purchases that hit cash immediately, owner distributions, reducing your liquidity, and then inventory ties up cash. So loan principal payments don't show up on the P&L. Like I said, you have the principal and the interest. Let's say your payment's $1,000. Your interest is only $200. That means on your P&L, you hit $200. That other $800 is on the balance sheet. Equipment purchases, if they're over $250, unless you take the safe harbor of $2,500, then now that hit the balance sheet. You don't see that $2,500 or $10,000 or $20,000 if you needed a new ultrasound or x-ray machine hitting over on that income statement until year end if you take all the depreciation. Your owner distributions, because you're trying just to break even. You're trying to pay your student loans. You're trying to pay for the new house insurance that went up by 25% because you're in a high-risk area. That is going to kill your cash flow. In the inventory, I wanted to get more inventory at year end, so I went out and spent $60,000. I now have to pay for that. I don't have that cash. It's on the balance sheet. It's hurting. Profit, your P&L versus the cash that's in the bank. Your profit will show your revenue, will show your expenses, and show your net profit. This is your accounting profit. Your cash in the bank, your statement of cash flows will show your loan principal payments, your equipment purchases, your owner distributions, your inventory purchases. It is the actual money available. That's why you might have a great net income, 100,000, 200,000, 50,000, 300,000. It doesn't matter. But you have the bank account, it's got 10,000. It has enough to cover your payroll. And that's it. That's the disconnect here that we have to get through. This is the cash flow illusion. Inventory and overhead expansion. As revenue goes up, so do your supply costs. So does the vendor spending, the subscription creep, technology costs, and marketing. These are all things that are incrementally going up as your revenue goes up because, yeah, I need more supplies. I have to buy more stuff from the vendors to be able to meet the needs of my patients. We need this or that subscription. We forgot about this one, but we need these new ones. Your technology. I needed a new computer for the new receptionist. Marketing. I need more patients to come in. Without monitoring your percentages of a profit on these, your overhead expands quietly. Higher revenue is higher tax exposure, but owners don't adjust estimated payments. There is no proactive planning, and cash set aside for your taxes isn't enough. This is where the taxes start sneaking up. You realize, hey, I've never made this much profit. All of a sudden, though, you have to pay taxes on all of that profit. This is a lot of stress, especially in quarter one, if you aren't proactively planning, proactively adjusting your tax payments from maybe $10,000 a quarter to $16,000 or $17,000 a quarter. You have to look throughout the year. Instead of are we growing, you should be asking, is revenue growth outpacing your expense growth? If you have a 40% revenue growth, I'm being extreme on this, but your expense growth is 60%, you will never keep up with what your expense growth is. You have to be able to do this incrementally. Your revenue growth needs to outpace your expense growth. Is cash flow improving month over month? What do I mean by this? You started the month with 20,000 in the bank, you ended it with 25,000. That's growing month over month. Here's the problem. You started the month out with 20,000, at the end of the month, you're at 18,000. What does that mean? That means with what you have, you burned $2,000 in cash. So now you can last potentially 9 months before if you have that same trend. That is the real questions. These are the real questions you should be asking yourself. You don't want to just say, is it okay? We want to reframe how you think about your business. The shift from reactive to strategic. Clinics that reduce stress will track KPIs monthly. You're going to make sure your gross profit margin, your revenue per doctor, all these KPIs are being tracked monthly. You want to review the margins consistently. What profit margin should you have? What sort of net income makes sense? Forecast 90 days ahead based off of what you've previously done and the growth you've been seeing. And then make hiring decisions based on numbers, not feelings. You need to also plan for taxes proactively. Taxes are one of your largest expenses. You have payroll, you have taxes. Neither one of those are going away unless you just sell everything, never work again, fire everyone. This will help decrease your stress level when you have more visibility. What financial clarity actually feels like. You know your break even. If I have my fixed cost right here, what do I need to break even? You know your payroll percentage of a target. Is that 40% or is that 60%? If I make $1 million a year, I want my payroll to be between 40 to 50%, $400,000 to $500,000. That leaves $500,000 for the other expenses, or $600,000. Know your tax projection. If you have a net income of $150,000, you need to know what your projection is going to be. You stop guessing. When financial clarity actually feels like something that's achievable, you stop guessing and you start planning. You don't have to just say, well, I hope this happens, or I'd really like for this. No, you know what's going to happen within 5-10%. Your confidence replaces stress. If your clinic has good revenue but still feels financially tight, it might not be a revenue problem. It might be a structure problem. Here at Henson CPA Group, we offer a free strategy call to walk through your current numbers and identify where the pressure is really coming from. I'm Joseph Henson, CPA with Henson CPA Group. My booking link is below. You can email me at joseph@hensoncpagroup.com. A lot of people ended up emailing Joseph, spelled how you expect, Joseph. I never got those. My email is joeseph@hensoncpagroup.com. I have now added an alias if you accidentally drop that first E, like everyone does. Until next time, though, I hope you have a great